The person with the most cash in the world is Warren Buffett. Berkshire Hathaway has over $130 billion of cash. Now, why do they have that? The answer is Buffett sees the same thing I see, the same thing we're talking about right now, which is in a highly uncertain world with a lot of vulnerabilities, and that's exactly what we're describing, that come home to roost, and that's how I see 2023. Cash will preserve wealth and then give you the opportunity to pick up bargains. A liquidity financial crisis is different from a recession. Sometimes you can have one without the other. 1990 we had a recession, there was no crisis. 1998 we had a crisis, there was no recession. The economy was fine in 1998, but the financial world almost came to an end. Sometimes they come together, and that's what happened in 2008. We may be looking at a scenario like that. By the way, $65 trillion in foreign currency derivatives, yeah, but try 1 quadrillion in total derivatives. I mean, that's foreign currency, and that was the focus of the BIS paper. But when you get into interest rate swaps and commodity swaps and swaptions and all the rest, that's 1 quadrillion, which, for people not familiar with the Q word, is 1,000 trillion. So you pointed to 65 trillion, and you're right, that's FX, but there's 1,000 trillion or 1 quadrillion of derivatives off balance sheet of the banking system, supported by collateral, a little sliver of collateral, and there's a dollar shortage, and that's getting ready to implode. A couple things you can do. One thing, I would increase my cash allocation. A lot of people hate cash. They're like, it doesn't have any yield. Why would I do that? I'm missing out on whatever, Bitcoin or stocks or whatever. Cash is extremely valuable. Number one, it performs very well in disinflation and deflation. Deflation, it could be even with a very low nominal yield, it can have a much higher real yield in a world where prices are going down. So it's a good deflation hedge. But more importantly, cash gives you optionality. If taking everything we just described about a potential stock market crash that could be 30% or more, a global liquidity crisis that could be worse than 2008. I mean, there are plenty of signs of both of those things. Well, if you're the one with cash, first of all, you're not going to lose money on cash. You will on stocks and other asset classes, but not cash. And then when this drawdown comes, when this collapse comes, you're the one who can go shopping. You can go out in the wreckage and say, oh, well, here's a good company. It's down 90%. I'll buy some of that. I'd also have a slice of gold. I recommend 10%. People always want to put words in your mouth. Jim Rickards says, sell everything and buy gold. I've never said that. I don't think it's a good strategy. 10%, yes. Now, if you have 10%, sit tight. It'll serve you well. If you don't, you might want to get some gold, because a lot of what we're talking about is going to play out in foreign exchange markets. We are at peak inflation. Inflation is going away very quickly, and the Fed moves are working out. It doesn't mean that the Fed won't blunder and make this worse. I think they will. We can come back to that. But, okay, so the inflation sort of came on the scene in mid-2021, in the summer 2021. By the fall, it was very high, and this is when Jay Powell was saying transitory, transitory, transitory. By November 2021, he threw in the towel. He said, okay, time to retire the word transitory. And then they started hiking rates in March. On March 1st, the policy rate, the Fed funds target rate, was 0. Today, it's 4.25%. It's going to go up another 50 basis points on December 14th. So, and then the next meeting after that is February 1st. So they're going to keep raising over 5, probably get to 5.25%. That's in less than a year. I mean, we've gone to 4.25 in less than 8 months, or just barely 8 months. So, but inflation is already off the top. It's going to come down a lot more. The markets are not ready for that. I see the inflation. I put gas in my car. I go to the grocery store. I see it just like everybody else. Home heating costs, and eggs, milk, bacon, food, gasoline, et cetera. But here's the point, Danielle. There are two major sources of inflation potentially. One is the supply side. So supply shortages, supply chain disruptions, the kind of things we've been talking about. That's called cost push inflation. Costs go up and it gets pushed onto the consumer. The other source is demand, what's called demand pull inflation, which is more psychological. Consumers are thinking about choices and they say, I was thinking about buying a refrigerator. I was going to wait 6 months, but hey, the price is going up. I better go buy it now before the price goes up. In the 1970s, we had both. We started with cost push from the Arab oil embargo, but it flipped into demand pull in the late 70s and it just spun out of control, and Paul Volcker had to crush it. Today, the inflation is coming from the supply side. Some of the things we talked about, higher fuel costs. I mean, everything has to be transported, so fuel is part of everything. It gets built into the price of everything, and there are other shortages and bottlenecks and costs that have to be taken up by manufacturers and distributors. So that's real. I'm not saying inflation isn't real, but it hasn't leached over onto the demand side. The psychology of consumers is not, gee, I better buy it today because the price is going to go up. It's like, no, I better save money today or watch my budget, et cetera. And here's the difference. Demand pull inflation feeds on itself. The more of it you get, the more of it you get. It does spin out of control. So the cost push inflation from the supply side tends to be self-negating. There's an old saying, the cure for high oil prices is high oil prices. If your SUV or Ford F-150 pickup truck, if you're filling up the tank, went from $75 to $150, which it has, that demand is inelastic. You got to put gas in your car. You got to get to work, take the kids to school, whatever it may be. But that means $75 in my example that you're not going to spend on dinner or a concert ticket or a vacation or a new dress or a new suit of clothes or whatever it may be. So that tends to, and so here's the Fed trying to deal with inflation, but they're dealing with it from the supply side. The Fed doesn't drill for oil. They don't drive trucks. They don't grow crops. They don't have farms, etc. The Fed can't do anything about supply side inflation except destroy demand. But here's the question. How much demand do you have to destroy to control inflation coming from the supply side? The answer is a lot. They're trying to get to a terminal rate. They're already there. They just don't know it. They'll be the last to know. So they're going to take rates to 5.25 or higher by March. But they're already at the terminal rate. They just don't know it. And so inflation is already coming down. And this is the thing that the markets and investors are not ready for. Inflation is going to come down fast. There's even some danger of deflation and a major U.S. recession in 2023. And no one's ready for that. I mean, people talk about recession, but it's going to be worse than they think. And we've seen this movie. $9 trillion of QE didn't do any good. I mean, how does the Fed do QE? They buy bonds from banks, give the money to the banks, and the banks give it back to the Fed as excess reserves. What does that do for the economy? Nothing. Zero rates, again, it doesn't work. They don't have the tools. With nothing in the center, they replicated the entire structure of Wall Street. So you have exchanges, custodians, futures, options, settlement, clearance, lending, yields, etc. This whole Wall Street infrastructure, financial infrastructure, around nothing. I mean, Tesla stock, for example, maybe you like Tesla, maybe you don't. That's an individual choice. But at least they make cars. There's a real car there. And even intangibles, insurance companies provide services. There's something there. In crypto, there's nothing there. But they've replicated this infrastructure. And so a lot of the wealth that's been generated in crypto is because you own a crypto exchange or you own a lender set. Now, that's all imploding. It's kind of a replay of 2008, except instead of, Bear Stearns, Lehman Brothers, Fannie Mae, Freddie Mac, and, Morgan Stanley was hanging by a thread, it's, FTX most prominently, but Genesis is kind of considering bankruptcy, et cetera. So all that is collapsing. So Bitcoin's not an exchange. It's not part of that infrastructure. It's just a coin. The best analogy I've been able to come up with, I have a lot more to say about it coming out of communications theory, but it's like a casino chip. If I walk into a casino and put my money on the roulette table and the croupier gives me chips, I can gamble them, I can play with them, I can make money or lose money, but when I leave, I go to the cashier and get my dollars back and walk out. If I take the chips outside the casino, they're worthless. I can't pay for dinner with casino chips. So cryptocurrencies are casino chips. You're in the crypto casino. Some people made a lot of money, and I know some of them personally. A lot of people have lost a lot of money. More have lost than made money, which is how casinos work, by the way. So eventually they'll all go to zero, but in stages. But what's collapsing right now is the infrastructure.